Hello, this is Joseph Gillette Sr. coming to you from Venture Capital Cross, and the topic for today are special risks of private markets investing. And this is a very important video because we've elaborated in other videos, and this is a big topic for discussion, the difference between public markets and private markets. And obviously, private markets investing is super risky, and we're digging into more granular detail about what those risks are because they're not apparently clear. Because what we see when we look at successful people that made a lot of money in private markets, we have a bias because we don't necessarily look at the losers or the risks, and they're not so widely advertised because the successful stories are obviously something that everybody sees when we think about stories like SpaceX and Elon Musk, or even if you want Bill Gates, which is an earlier story. But all these successful stories came out of venture capital and private equity or private markets. So the first risk we want to go over is execution risk. So when you invest in private companies, you often do so indirectly. That means you're not buying shares on the cap table. You're investing in a vehicle which owns shares. And even if you were buying shares directly, there would still be execution risk, but when you have SPVs, the risk becomes less obvious because you're not really interacting with the company directly. So what can happen? The company can decline a transaction. The company can unwind a transaction. I've seen that happen years later. If, let's say, the buyer is doing something the company doesn't like, they can unwind your transaction. And that's unusual because in public markets, you could, I'm not aware of it, maybe it's possible, but it'd be very unlikely. I'm not aware of a case where in public markets that could happen. But in private markets, company doesn't like you for some reason. I mean, if let's say you're doing something illegal or you're involved in some kind of Ponzi scheme or something like that, the company can unwind those transactions, or they could do a forced liquidation. So there's a lot of variables, but basically there is execution risk when you're buying shares. And you can have a situation where you think a transaction is done, and then time goes on, something happens, which it would be similar to what happened in the case of FTX. FTX was a fraud, basically, and at some point they said, we're liquidating all the shareholders. Now, what's unique about the FTX case is they held assets other than their shares, like Bitcoin, investments in other companies, and so those shareholders, some say they were made whole, others say they were profitable. There's a big debate about that. And because in FTX you had customers who were claimants, and you had shareholders who were claimants, and then you had creditors, and then you had, of course, the bankruptcy taking their piece of meat. So there were a lot of things going on, but the point is most companies, when they file bankruptcy or there's a fraud, investors get nothing. In the case of FTX, the liquidator sold off all the shares and gave it back to the creditors and the claimants through the bankruptcy process. So that's a little bit unusual, but the point is you have that risk. Your investment in a company, it's not solid like a rock. And I'm not saying public companies are solid like a rock, but in private markets you have that special execution risk that just simply doesn't exist in markets that are more liquid. In private markets, the company controls the whole market. It's almost like they are the unique specialist market maker and everything else. So here's a second risk, which is pretty common, and I went through this as a shareholder, and it's just a risk that needs to be disclosed, and there's no telling if a company will do it or not, and that is dilution. So what a company can do is, let's say they've raised $10 million at a $10 million valuation, so they can't possibly sell any more shares. They can then dilute the value of your shares, so instead of owning 100%, you now own 50% so that they can sell more shares. And there have been cases where companies will just dilute, so your investment may be worth nil just after all the dilution. Now, the big companies, and by big I mean $1 billion or more valuation, or maybe even, I'm not sure that the billion is the exact cutoff, but larger companies that want to be unicorns and big companies, they never dilute, and if they do so where the investors actually get more. So you may have less shares, but your equity is always growing. And the reason they do that, because once you dilute, it's very difficult to raise money from more investors, because they're going to say, well, what are you providing me as far as a guarantee that you're not going to dilute again? And the answer is usually, well, there's no guarantee. So dilution is a risk, and that's why many investors look to the bigger companies because they're less likely to dilute. A down round. So a company, let's say you invest in a company at $100 million valuation, they may raise money at a lower valuation. So they've just reset the value of shares by 50%. It happened, it's always possible. Regulatory risk. Regulatory risk is when a government might shut down a platform, causing the business to suffer irreparably. We've seen this with ByteDance and TikTok, and that's an ongoing story, and that's probably, it's going to end up positive for all involved. There's going to be a deal made with providing U.S. access to the various encryption algorithms or whatever surveillance is going on. It's probably going to be resolved, but nonetheless, it's a good example of the government can say, I don't like your platform, I'm shutting you down. We had this in 2012 with the Dodd-Frank regulations and the currency market. There were in the US like 500 Forex brokers, something, it was a huge number. And some of them like Hotspot and a couple groups had platforms that were pretty robust. And they just said you need $50 million minimum and it has to be approved by NFA, and there are all these new rules, and basically it just wiped all of them out of business. So all the Forex platforms in that time were regulated out of existence. That can happen to any business. It's a calculable risk, and you can take it like a very rare chance that something like that will happen, especially if it's a company like Kraken or Coinbase is public now, but let's say Kraken is private. Right now we have a crypto positive administration and crypto positive lawmakers, so that risk is close to zero in this environment. But things can change. There can be a different administration who's against crypto. They could, with one rule, make Bitcoin illegal, for example. I'm not saying that's gonna happen, but the regulatory risk is a little bit calculable, and this becomes important when you're dealing with other countries, especially. The U.S. is kind of the benchmark for the world, but there are many countries where lots of interesting things happen. Skype was from Europe. There's been tons of innovation in other countries, not only software and startups, but just in banking. And Nubank, I think, is from South America, or at least was started in Brazil or something like that. So there's a lot going on. The world is a big place, but each government is very different. The United States government is very different than Switzerland. Like in Switzerland, they don't have a president, they have a committee. It's 12 people. And you might say that's good or bad, but the point is, when you look at regulatory risk, you're looking at what is the ruling regime's ability to create laws, regulations, and enforce them positively or negatively for your business. And your business doesn't have to be a platform. It could be a healthcare. Regulatory risk exists really in any company. I know SpaceX has had issues with the state of California that doesn't like SpaceX politically, so they're using that as a tool to just be annoying. They can just launch rockets in Texas, and that's what they've been doing, but they have to issue permits and things like that. So that's an important risk to keep an eye on, even though it's not. It's something that if it happens, it would be devastating, high impact, low probability. And all of these are going to be in the article we're doing on this, and then it's going to be in the description of the video once it's live. And the last one, and this is pretty important in some cases, it's very important, in other cases it's kind of not important. That is key man risk. So imagine that you start a company and you're the only one who knows everything what goes on in the company. So there's one person who knows everything. That is known as a key man. Now, when you're a startup, they will ask you to get key man insurance on that person, that if he gets hit by a bus, there's a payout. But if he does get hit by a bus, you might get the 10 million from the insurance, but that's all you're going to get. The business can't continue without the key man. And that's why this is a very important risk. And we had a situation recently with Feastables. Mr. Beast is a YouTube influencer that has billions of followers. He's very popular, and he's raising money for his Feastables candy bars that he's selling in Walmart and everything else. And a big private equity investor noted that there's too much key man risk. What if Mr. Beast gets arrested? Or what if this guy does one thing wrong and there's no more business, because his brand is the business. And no matter how many people Mr. Beast hires, it's the brand that's the draw to those candy bars. In other words, it's not possible to replace Mr. Beast. He does have a whole staff and a team of people, and they're amazing, but there's only one Mr. Beast. So once that brand is tarnished for whatever it may be, and sure enough, a couple months after that investor noticed that, there was a scandal. It turned out maybe, I'm not following it, but maybe it was a nothing burger. But the point is that with the key man risk, you always have the risk that something can happen to that founder. Steve Jobs died pretty early. Another example is Elon Musk. And now I would say about SpaceX, I think that what Elon's done at SpaceX and Tesla, but that was a long time ago, he's hired lots of smart people that if he disappeared for 5 years, all of these companies would work well without him. So he is the founder, and he is the hands-on guru who's in there working. And there's this great story you can read if you're interested about it, where he was living in the Tesla factory, just sleeping in the office on cots, just working constantly. And during that time, he was doing all these things because it was necessary to build a foundation, but obviously he's not doing that now. So what he's been doing is he's getting these businesses to a point where they are running by themselves by hiring key people. For SpaceX, some of the employees at SpaceX, I mean, even the coffee barista at SpaceX, the quality of employees at SpaceX is very high. Let's put it that way. There's someone specifically, I mean, he has a CEO and president. I think he's the CTO. But the point is, regardless of all of the different roles, he has created these companies to be set up for success. That he's involved, so he's helping, he's working. But if he wanted to take a vacation to Mars for a year, he could do so, and the companies are going to continue. So key man risk is something that is very important only if you have that type of situation. Like if you look at like Airbnb, for example, once Airbnb kind of got started, it probably the key man risk was low because Brian, the founder, Airbnb is not a complicated business like SpaceX or Tesla. It's not an engineering, it's more just a very simple idea of vacation rentals. And once they had traction, running that business probably could have been done by other people. So key man risk is something that it either applies, well, it always applies a little bit, but it either applies a lot. Like in the case of Mr. Beast, I think that's the best example. You couldn't do that business without the Mr. Beast brand. If that brand didn't exist or something, Mr. Beast got sick or something like that, God forbid, there would be a problem. They couldn't hire like Mrs. Beast. It wouldn't be the same. He is the one who is going to be necessary. And I think SpaceX is a good comparison because Elon has created this empire of high quality workers. It really is a meritocracy at these companies, and they hire great people. And Neuralink, all of these companies are great examples of meritocracy. So I think in those cases, the key man risk is less. But these are all things to consider. So obviously, private markets investing is not for everyone. It's possible you can make lots of money, but it's also possible you can lose. So I would say just bear in mind, to make this really easy, just assume that you're going to lose all your money. So if you take like 5% of your portfolio, let's say, and you invest 100% of it in venture capital private deals, I'm not saying assume it's going to be lost, but mathematically when you're dealing with your portfolio as far as risk assessment, you can say this is my risk capital. If I lose it, it's not going to kill me. It's not going to ruin my portfolio, and then just forget about it. Because anyway, it's going to take 5 to 10 years for that to come to fruition. Even in cases of extreme growth, it's not happening overnight. So these are all things that are rare, but they are special risks, and we're going to build this into our documents and not only disclose this to new investors in private markets, but understand that things happen in markets, and you can buy something and then the market breaks or crashes. I mean, there's different kinds of risks in public markets, but investing is risky. You never know what's going to happen. The whole point is that the financial industry, hedge funds and Wall Street people try to manage that risk, and it's possible to manage risk, and it's in some cases possible to mitigate risk, but you cannot eliminate risk. That's the point. You cannot eliminate risk. There is risk waking up in the morning. cannot eliminate risk. So these things do happen. It's rare. FTX was a very rare case, but it happened, and FTX may have been an example of a bad outcome or a bad situation with a good outcome, because a lot of investors were paid back. If not everyone, if everyone was not made whole, a lot of investors were able to get a lot of what they had back. And so it happens. You never know. If you had told FTX investors 6 months before that this was going to happen, no one would have listened. There was this guy, Markopoulos, who was warning people about Bernie Madoff years before that Bernie Madoff was discovered, and no one wanted to listen to him. He took his file to the regulators, to other investors, because he was part of the investment community, to just a number of groups, and they looked at it, and then they just looked at him with a blank stare. So all of these things are good examples. In the past 50 years, we have lots of really great examples of what to look for, and there's always going to be something new. So the point is that you can't take the past and say, oh, well, based on the past, I can identify all the risk in the future. You can't do that. But what you can do is you can build a framework to manage the risk, and you understand, aha, okay, private markets, that's risky. I'm going to take some of my money that I can afford to lose and put it into the high risk stuff. And then the lower risk stuff, which is more on the public markets investment side, you get common investments in like basically indexes, mutual funds, stuff like that. Tax-free munis is always popular. What's the chance the city of New York is going to default on their municipal bonds? It's very low. But it's also possible in the bond market. You have default risk, and you have junk-rated securities and A+, and there's rating agencies and all that. So the problem with private markets is you don't have ratings agencies, and you also don't have metrics to compare. So we don't know exactly how much money SpaceX is making every quarter. We can guess, and there are some smart guys out there with some data platforms that are really doing an amazing job at filling in the blanks of all the data, painting a picture. But you never know. Companies can lie, things happen. At private markets, there's no rating agencies, there's no transparencies on seeing the financial documents. So we can't even begin to make a picture of comparing, let's say, the Feastables to SpaceX. There's no way to compare because we don't know. It's a black box. So all of these special risks you should be aware of, and not necessarily you have to worry about them, but this is a way, if you wanted to deal with it, if you're a professional in this business, or if you wanted to do the homework yourself and read up on these companies, this is how you would do it. You want to look at these risks because these are the things that can go wrong. On the upside, how do you know how well a company's going to do? That's impossible because you don't know what the future is going to bring. So now with this special risks, we've covered kind of the dark side. Those are the things that can go wrong. What can go right? It doesn't really matter. If you make 50% or 100%, there's no way to, you're not going to be able to figure that out because there's no kind of rate of return. So bear all these things in mind and just think about if this is really for you, and maybe certain sectors or certain companies will resonate with you, keeping this special risks in context. For example, the Mr. Beast thing popped out to, I didn't really think about this until this investor mentioned it, and it's a good point. Without Mr. Beast, you can't, Feastables is going to be a totally different thing because it relies, all the money they've made in Walmart and these big stores relies on him making these videos and promoting it. Without that, what do you really have? You're no different than Hershey's or all the other competitors. So the influencer status of the brand and of the man is a great example of a key man risk. So we're going to put this in the description of the video and also have an article, and we hope that your investing goes well and that you're safe and happy and have all the things you need in this life. So we wish you the best luck investing and manifesting to make your own luck. Have a great day. We'll see you on Venture Capital Cross. Thank you.